We're going to go to Marc Faber here, and we'll see whether we can continue to stabilize. Joining us on the CNBC Newsline, Squawk Market Master Marc Faber, Managing Director, Editor, and Publisher of the Gloom, Boom, and Doom Report. In the last few times you've been on, Mark, and I do have a pretty good memory because you've been talking gold big time. So you've made, I don't know how many hundreds of points you've been right on about that. And I think we asked you about the possibility of QE3. And you said you thought there'd be QE13, and I'm reading your most recent comments, and I was hoping that we had flushed some of the bad feelings out, but you think this is just the beginning of something that could be pretty serious.
Well, my view is this. The market has experienced everywhere huge technical damage, and near term, as of today, all markets are extremely oversold. So a rebound is going to happen today or tomorrow, on Monday. But the damage technically is so great that the rebound, no matter whether QE3 happens right here, it's unlikely to lift markets above the May 2nd high on the S&P at 1370. And I think we'll drift lower. And my, say, nearer-term target in October, November would be something like 1100, 1050 on the S&P. Then we'll have to see whether QE3 or QE4 will come and whether the markets will stabilize.
Did you know, Mark?
In general, I would be using rebounds as a selling opportunity.
Yeah. So all through the debt, that ridiculous thing we went through over here, all through that, you thought treasuries were rallying because of the slowing economies, and not just the U.S. but worldwide. I mean, that was clear to you that's what was going on?
I think treasuries are perceived still as a safe haven because everybody knows the U.S. has an endless ability to print money. So the interest will be paid. The question is, governments can default in two ways. Either they just stop paying the interest and there is a debt restructuring like Argentina went through, or they just pay the interest and the principal eventually in a worthless currency. That's the way the U.S. will likely do it.
Yeah. One last thing, Mark. You say people are going to be hoping that some of the government numbers will help stem the slide as they improve, and do you still think that the numbers are going to continue to actually get worse before they get better?
Well, I think there may be other factors at play that, corporate profits have been very, very good in this recovery since 2009. I think maybe in the second half of this year, corporate profits will somewhat disappoint, and we may have liquidity problems in the markets in terms of financing. If you look, say, at mining companies, the gold miners are hit very hard and the gold price went up. So people don't trust paper anymore. Right. That is one of the problems.
Mark, on the gold front, one of the interesting sort of divergences in the market was the market tanked and gold tanked yesterday. How do you explain that?
Yes, it didn't tank a lot, and it had gone up very substantially before. But you understand, gold and silver became overbought, and they are due for a correction. Like the US dollar is oversold, it's due for a rebound. So we could have a period, say, next week or so, where equities rebound and gold and silver correct on the downside. But I've calculated the gold price at this level is not particularly expensive when you compare it to government debts around the world and compared to the monetary base expansion over the last 20 years and so forth and so on. So I would actually use weakness in gold, and ideally it would drop $100, $150. It's not a prediction, but it could happen as a buying opportunity.
Mark, what's the end game here? Is it the collapse of Western civilization as we know it, the capitalist system? Where are we going here? How must it inevitably end, in your opinion?
You have a computer. Occasionally the computer will crash and then you have to reboot it. That will happen to the global economy. Now, before this happens, there'll be much more money printing because basically the central banks are willing to do that. by printing money, problems are not solved, but they can be postponed and they become larger. It's like the recession in 2001. Had there not been massive money printing, would have been steeper than what we had, but equally, we would have avoided probably the financial crash in 2008. The next time we have a global economic crisis, it will be much worse than 2008. Before this happens, there will be money printing and there will be war. And then the whole system will collapse. And that's why I'm advising people, you have to think it through. In a total collapse, you don't want to own government bonds and cash. Equities, they don't perform well, but at least you still have the ownership of companies. And precious metals in that environment do relatively well. And, of course, oil would do well if there was a war.
And guns. Great. Great.
Did you just say in guns?
Yeah, in guns.
My fault for asking the question? Or
no, when you ask about the end of capitalism, I know you're sort of hoping for that eventually, having been in Russia 7 years. I mean, that's how you're indoctrinated over there. You're supposed to spread that here. I know
6
that.
years yeah.
Hey, all right, Mark. I will say one thing that you said, though, Mark. In some of your notes, you said we're at the beginning of a big bear market, but you actually broached the possibility that the S&P gets somewhere near its old highs with a QE3. So you are not bearish necessarily all out from right here. You're looking for some rebounds in between now and the final end or whatever.
Yes, I think that my view was since February that the correction was overdue. That would take the market down, say, 20 to 25, possibly 30% in some markets, and a lot of stocks are down 30% already. And that then QE3 would come in and there'll be a rebound. And I think this rebound will start somewhere in October, November, but no new highs.
All right.
And eventually will drift lower, but I don't think we will go back to the 2009 lows, 666 on the S&P on March 6, 2009. Because there'll be so much more money printing. You can take weakness in assets either through asset prices going down or through the currency or a combination thereof. Mm-hmm. So say in US dollars, the market in the US this year is down a couple of percentages. In Switzerland, the market is down 20%.
Yeah, exactly.
But if you adjust the US dollar for the Swiss franc, and don't forget this year the Swiss franc has appreciated 22% against the US dollar. So for a Swiss franc holder who bought American shares on January 1st, he's lost something like 25% already.
Yeah. All right, Mark Faber, thank you. We appreciate your where are you right now? Where are we talking to you?
I'm in Zurich.
You're in Zurich right now. Okay.
Yes, in a sleazy hotel.
Oh, I know. I assume that, and I don't want to know anything else that's going on there and what you're planning after this phone call. But thanks, Mark. We appreciate it.
Well, I thank you very much.
Okay.
Bye-bye.
We'll talk to you soon.